Today, what I'm going to explain to you is a concept that you typically only learn in those trading courses that cost you hundreds or thousands of dollars. Actually, I'm not even sure if they teach you this. If you understand how this works, you will be able to utilize this and earn yourself some decent return in the future. Before we start, make sure you click the subscribe button so you don't miss out on my videos, which we will talk about investing strategies and other useful personal finance. Okay, so Nikola's stock price dropped big time today, over 20%. But why? Some of you may wonder, did Nikola's put option price drop as well? For those of you who are less familiar with how option works, basically, option price is a premium that you pay to the option seller, also known as the option writer, for the right to sell or buy the stock at a set price at a specific time in the future. Typically, when you think a stock is going to go up, you'd pay some premium for a call option, hoping that the stock price rise past your target price before the expiry date. And when you think a stock is going to drop, you'd pay some premium for a put option, hoping that the stock price drop below your target price before the expiry date. And because option prices typically move up and down much greater than stock prices, they're typically used as a leveraged trading strategy. So in normal circumstances, when stock price increase, call option price increase as well, because people expect the stock to continue to rise and the put option price will drop. When a stock drop in price, call option price decreases and put option price increases. Today, Nikola's stock price dropped over 20%, and yet for options that are several weeks and months away from expiry, both call option and put option price dropped. For call option, it's easy to understand because it's supposed to drop. That's very normal. But why did put option price drop as well? And the reason is simple. As I explained in my previous video, this drop was expected already by the put option traders. The drop was already priced into the premium. Usually it's hard to look up historical prices of an option, but because I actually shorted some put options back in June, I'll share those information with you. Back in June, I shorted several put options when Nikola's stock price was in its 90s, 80s, 70s, meaning I sold these put options to people who wanted to bet Nikola's stock price to drop. The premium I received from selling these puts were astonishingly high. For the $30 strike, the premium was 40%. For the $60 strike, the premium was 56%. And for the $75 strike, the premium was 60%. This meant that I only start to lose money if Nikola's stock price dropped below 25.50 by July 17th, which it didn't, and below $18, $26, or $30 by September 18th. And also that is if I haven't buy the options back by then, which I actually did already for some of them just to secure my gain. On the other hand, if you were the buyer of these specific options that I sold, it'd be the exactly opposite. You'd only start to make money if the Nikola stock price dropped below 25.50 by July 17th, which it didn't, and or below $18, $26, or $30 by September 18th. Typically, in option trading, premiums is only a small percentage of the stock price. And that is why options are typically considered as a leverage strategy, but in this scenario, it's actually not. The reason is because when Nikola's price was above $70, a lot of people wanted to short the stock, thinking it would drop rapidly. And due to the low number of shares for trade, the borrow cost for Nikola stock was extremely expensive. The borrow interest cost went as high as 600%. What does 600% mean? That means for every 2 months, your interest cost is as much as the stock price itself. In another word, if the stock price doesn't drop fast enough, you'd be losing money just paying the interest alone because you needed to drop 50% in 1 month just to break even. Some people thought, okay, I don't want to pay that interest. Or their broker is probably not even able to borrow the stock for them to short. So they went and buy put option instead. With so many people wanting to buy the put option, it drove up the put option premium to an astonishing level. This scenario typically happened to newly IPO stock that had insufficient public trading shares and with an overvalued stock price, which drew in a lot of short sellers that at the end drove up the borrowing cost. And when the stock price finally dropped due to more shares on the market, well, the borrowing cost dropped as well. And so does the put options premium. So even if you were correct betting that the Nikola stock price to drop, and it did by 50% now compared to its high, you might still be losing money on the put options. But now knowing how this whole thing works, next time you can be like me, take advantage of the astonishingly high option premium. This was a lesson I paid and learned through short and tail rate during the cannabis bubble. And now I'm sharing this strategy with you for free so you don't make the same mistake that I did before and can make the money like I did this time around. If you like the video, please help out by clicking the like button and make sure you don't miss out on future videos by subscribing to the channel. I will talk about what I think about Nikola going forward. Thanks for watching. See you next time.